Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Scotts Miracle-Gro Company quarterly report. The Scotts Miracle-Gro Company offers a wide range of products and services for lawn care, gardening, and indoor gardening. Their product portfolio includes lawn fertilizers, clover and grass seed products, spreaders, and other durable products. They also provide gardening and landscape products such as water-soluble and continuous-release plant foods, potting mixes, garden soils, mulches, and live goods. In addition to these products, the company offers hydroponic solutions that enable users to grow plants with minimal soil usage. Their lighting systems and components are designed for indoor gardening, while their insect, rodent, and weed control products cater to home areas. Furthermore, they offer non-selective weed killer products for effective weed management. The Scotts Miracle-Gro Company sells its products under various brands, including Scotts, Turf Builder, Miracle-Gro, Ortho, and many others. Their customer base spans across multiple channels, including home centers, mass merchandisers, warehouse clubs, hardware stores, nurseries, garden centers, e-commerce platforms, and food and drug stores. The company serves indoor gardening and hydroponic distributors, retailers, and growers as well. Overall, the Scotts Miracle-Gro Company is a leading provider of lawn care, gardening, and indoor gardening products and services, catering to a diverse range of customers across various channels. Scotts Miracle-Gro Co.'s stock price has remained relatively stagnant over the past year due to a combination of factors. One major reason is the company's struggle to adapt to changing consumer preferences and trends in the gardening industry. As consumers increasingly opt for more sustainable and eco-friendly products, Scotts Miracle-Gro has faced challenges in keeping pace with this shift. Another factor contributing to the lack of significant change in the stock price is the intense competition in the market. The company faces stiff competition from other established players, as well as new entrants in the industry, making it difficult for Scotts Miracle-Gro to maintain its market share and revenue growth. Additionally, the company's reliance on a few key products has also been a concern. While these products have historically been profitable, they may not be enough to drive significant growth and innovation within the company. This lack of diversification in product offerings could limit Scotts Miracle-Gro's ability to expand its market share and increase revenue. Furthermore, the company's efforts to expand into new markets and product categories have had mixed results. While some initiatives have shown promise, others have failed to deliver expected returns on investment. This has led to concerns among investors about the company's ability to execute on its growth strategy. Overall, Scotts Miracle-Gro Co.'s stock price has been impacted by a range of factors, including changing consumer preferences, intense competition, product diversification challenges, and mixed results from new market initiatives. These challenges have contributed to the lack of significant change in the stock price over the past year. The Scotts Miracle-Gro Company market capitalization of $4 billion is materially smaller than most of its industry peers of roughly $7 billion. The Scotts Miracle-Gro Company trades at a higher price-to-earnings ratio of 23 times and a lower price-to-book ratio of -7.46 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 113% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 4.09%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. A significant contributor to the decline in revenue is the decrease in net sales, which has dropped by $12.2 million from $300 $66.6 million to $354.4 million. This reduction can be attributed to lower sales volume in the U.S. consumer segment, where a 5.2% decline was observed. Furthermore, the Roundup marketing agreement has also led to decreased net sales. However, this negative impact is partially offset by increased pricing in the U.S. consumer segment, which saw a 1.8% rise. The sale of a subsidiary, the Hawthorne Collective, Inc., on March 14, 2025, may also have an impact on future revenue, although its exact effect remains to be seen. The net income of the company experienced a significant decline between 2024 and 2025. The net loss increased from $-69.5 million in 2024 to $-125 million in 2025, indicating a decrease of $55.5 million. Furthermore, the net income decreased by 52.4% over the same period, dropping from $45.8 million to $21.8 million. Despite this decline in net income, profit margins showed an improvement due to various factors. The gross profit margin remained stable at approximately 25% in both years, while lower impairment, restructuring, and other charges contributed to the increase in profit margins. Additionally, a decrease in selling, general, and administrative (SG&A) expenses also played a role in this improvement. However, the net loss margin increased from -18.9% in 2024 to -35.2% in 2025, indicating that the company's profitability issues persist despite some positive trends. The company's financial performance indicates a strong ability to generate cash from its operations. According to the provided information, the company has been consistently producing positive operating cash flows over the past 2 years. This trend is evident in both 2024 and 2025, with operating lease cash flows contributing positively to the overall operating cash flow. The data on page 27 highlights that the company's operating lease cash flows have been a significant source of positive operating cash flow, amounting to $21.2 million in 2025 and $19.8 million in 2024. This suggests that the company's leasing activities are generating substantial cash inflows, which is a testament to its operational efficiency. Furthermore, page 35 explicitly states that the company is indeed generating positive operating cash flow. This confirms the overall trend observed from the data on page 27 and reinforces the notion that the company's operations are producing sufficient cash to meet its financial obligations. The company's debt level has shown mixed results over the past year. While the current portion of debt increased significantly by 410% from $54.6 million to $278.3 million, the total debt only rose by a relatively modest 19.5% from $2,119.7 million to $2,542.3 million. However, net borrowings on debt instruments actually decreased by 9.1%. This inconsistency in reporting may indicate discrepancies in financial data. In contrast, interest expenses have consistently shown a decrease over the past year, with a notable drop of 19.8% from $33.9 million to $27.2 million. It is clear that the company has managed to reduce its interest expenses significantly. The performance of various segments and regions in the company's operations has been mixed. On a positive note, the U.S. consumer segment showed strong results with net sales reaching $328.5 million and a segment profit of $9 million. However, other segments have struggled. The other non-reportable operating segment incurred a significant loss of $1.7 million, indicating underperformance in this area. The consolidated and other segments also experienced a decline in net sales, from $366.6 million to $354.4 million, resulting in a substantial total loss before income taxes of $-63.3 million. Furthermore, the Hawthorne business has been classified as held for sale and is expected to be sold within 12 months, suggesting that it may not be contributing positively to the company's operations at present. Additionally, the U.S. consumer reportable segment saw a decline in net sales by 3.8% from 2024 to 2025, indicating a downward trend in this area. Overall, while some segments have performed well, others have struggled with declining sales and significant losses, highlighting areas that require attention and improvement. Management is projecting a significant shift in the company's strategy with the sale of its Hawthorne business within the next 12 months. This move is expected to have a positive impact on the company's overall outlook. The seasonal nature of the consumer lawn and garden business, which accounts for most of the annual net sales, will continue to be a factor in the company's financial performance. However, management is confident that investments in property, plant, and equipment will support the business and drive growth. Additionally, they believe that cash flows from operations and borrowings will be sufficient to meet debt service, capital expenditures, and working capital needs for the foreseeable future. Furthermore, management does not expect environmental matters to have a material impact on the company's financial condition or results of operations. Overall, management is optimistic about the company's outlook, citing the strategic shift as an opportunity for growth and improvement. The company has a history of rewarding its shareholders through various means. One way it achieves this is by paying dividends, which have been consistently paid out over the past 2 quarters. In fact, the company has paid out $38.3 million in Q4 2025 and $39.2 million in Q4 2024. In addition to paying dividends, the company also engages in share buybacks, a practice that allows it to reduce its outstanding shares and potentially boost earnings per share for existing shareholders. The company has indeed bought back shares in both Q4 2025, $8.3 million, and Q4 2024, $15.6 million. Concerns about inventory buildup and supply chain disruption. The company has expressed concerns regarding inventory buildup or supply chain disruption. Specifically, an increase in inventory levels of $2 million was observed between September 30, 2025, and December 27, 2025, page 11. This suggests that the company may be holding onto excess stock, which could lead to potential losses if sales do not pick up. Furthermore, lower sales volume in the U.S. consumer segment has been reported due to a decline in demand for certain products such as fertilizer, grass seed, plant food, and controls, page 37. This decrease in sales may be contributing to the inventory buildup issue. While there are concerns about supply chain disruptions globally, page 32, it is not specific to the company's operations. However, retailers' reliance on timely delivery has been identified as a potential challenge for inventory management, page 31. Overall, these factors suggest that the company needs to address its inventory levels and sales performance to mitigate any potential risks associated with supply chain disruptions. That concludes the financial summary for the Scotts Miracle-Gro Company. Feel free to comment below, and I will be happy to answer them when possible.